Okay, so first 2 points of discussion. I would recommend, it would help if you make running notes. There are a lot of small points, or later on watch the video and make it. Objective of financial statement, importance of financial reporting standards in security analysis and valuation. This is the point of discussion. Objective of financial statement is to provide economic decision makers with useful information about performance and changes in financial position. Reporting standards are designed to ensure that different firms' statements are, number one, comparable, and to narrow the range of reasonable estimates on which financial statements are based. Right, so at the end of the day, accounting is a part of your estimates, but at least you keep that range limited, otherwise the financial statement would be completely meaningless. Are you following this? For example, if I take an asset, let's say I buy a car and I say that life of this car is 100 years, right, and I charge depreciation, that would be completely meaningless. So they at least try to narrow it, saying that you cannot have such big life or such low life, so on and so forth. This aids users of the financial statement who rely on them for information about the company's activities, profitability and creditworthiness. Yes. Provide economic decision makers with useful information about financial performance and changes in financial position. So financial performance is shown where? On income statement, typically on the income statement, and changes in financial position comes where? Balance sheet. Next 2 points of discussion. Roles and desirable attributes of financial reporting standard setting and roles of ISO. Okay. So every country will have a body which will set the accounting standards. In India, the accounting standards are set by Institute of Chartered Accountants of India. Now, these are not government bodies. These are said to be as professional organizations. So in the same fashion, in US, the organization is called FASB. And in the same fashion, for the rest of the world, I mean the one body which would kind of make accounting standards for the entire world, this body is called IASB. Financial Accounting Standard Board and International Accounting Standard Board. What we want to see is what kind of a role these people have and what should be the attributes. I mean, which body would be considered as a good body. And then there's an organization called ISO. So what does this organization do? We'll have to see that. Standard setting bodies are professional organizations. So please remember this, not necessarily they have to be government organizations that establish financial reporting standards. The two primary standard setting bodies are IASB and in US FASB. These are the desirable attributes. Number one, they should set for themselves high professional standard. Please be careful because there might be a question again on this. They should have adequate authority and resources. So if they make accounting standard and they get to be approved by the government, again they don't have sufficient authority and then it's not a good body. They should have a clear process. The process should not change. A well articulated framework. Later on we would be studying the framework given by IASB. Okay, so they should have a framework that how accounting standards should be made, the entire process should be defined, objective should be defined. They should work independently but seek input from the stakeholder. So it is important not to be affected, but you cannot be isolated. There have been questions around this area that you cannot be completely isolated and aloof from them. You have to be independent, take your own decision, but take inputs from the stakeholders. Not be compromised by special interest, don't be bribed very easily, and make decisions in the public interest. Regulatory authorities, like in India we have SEBI, that enforce compliance of financial reporting standards. Regulatory authorities include SEC, Securities and Exchange Commission in US, and FSA, Financial Services Authority in UK. So these are the two you need to know. SEC in US and FSA in UK. Next point is ISCO. Many national regulatory authorities belong to the ISCO. Okay, so for example, SEC in US, FSA or SEBI for that matter, all these organizations are a part of ISCO. So ISCO is kind of a global body to which your regulators are members. समझ में आ रहा है? Are you following this? And ISCO has given that there should be 3 objectives of financial regulation. So SEBI or SEC, these are financial regulators. So what should be the objective? First objective should be to protect investors. Second, ensure fairness, efficiency and transparency of the markets. And number third, which is very important, is to reduce systematic risk. What is systematic risk? Systematic risk. Yes, the risk that cannot be eliminated is as a whole, the risk that exists to the entire market. If something goes wrong, let's say that Fed comes and suddenly increases the interest rate drastically, then all the stocks might fall, right? So these kind of risks are called systematic, the ones that cannot be eliminated very easily, cannot be diversified away. So 3 objectives of financial regulation, and remember them, because if you see a question which says least likely and one of the options says reduce total risk or reduce unsystematic risk, then those would be incorrect options. Okay, so the correct ones are protect investors, fairness, efficiency and transparency, and reduce systematic risk. See, operating independently, they have to be independent, but they have to take input from the stakeholders. This point. Work independently, but seek input. Actually, none of them. The question has got incorrect. Status of global convergence of accounting standards. Okay, so what is the story? The story is that a few years back, all these accounting standard setting bodies met and they said that it's very difficult to compare a financial statement made in Singapore and in India with US. So let's come and let's have a common set of financial statement. Right, one statement that would be applicable to all the countries in the world, and that process is called convergence. Okay, so you might have heard very recent statement, the Ministry of Corporate Affairs, I think a couple of weeks ago, they came and said now the proposed date of convergence of IFRS in India is 1st of April 2015. That means starting from 1st of April 2015, all the listed companies in India will start using IFRS. So in the same fashion, the entire Eurozone currently is on IFRS. Okay, a lot of other countries have started their process for migration. So that process is called convergence. So we want to see what is the status. And second, ongoing barriers to developing this universally accepted. So what could be that barrier to the process of convergence? Barriers to developing one universally accepted set of financial reporting standard include: number 1, differences of opinion among standard setting bodies and regulatory authorities. For example, let's say that the FASB, US body, might feel that LIFO is a good system. We should have LIFO inventory management. But ISB says that no, we are not allowing LIFO. And there's a difference of opinion. Right? So this is one of the hindrance in convergence of IFRS all over the world. Differences of opinion. Number 2, political pressure within the countries. Okay, for example, that if IFRS comes, it would come up with very stringent set of accounting standards on derivatives. If they come it might not be so beneficial to a few IT companies in India, right? So then IT companies lobby, they kind of really opposed to the fact that IFRS would be converged to India earlier. So in fact, we have been changing our proposed dates. We originally thought 2009-10, then we postponed to 13, and then now postponed to 15. That's because some of the bodies in India were opposing it, right? So political pressure within the countries from the groups affected by changes in reporting standard. 2 points. Are we good to move here? This is an important point. You might want to write it down. What happens in US is that if you've used any other accounting standard and if you've reported your financial statement, you have to prepare a statement, reconcile that to US GAAP. For example, if I'm in US and if I've used some, let's say Japanese AS, if I've used Japanese GAAPs, then I will have to prepare a statement wherein I will have to reconcile my financial statement as per the US GAAP financial statement, but that rule is not applicable for IFRS anymore, which means SEC no longer requires IFRS reporting firms to reconcile their financial statements to US GAAPs. And is this a good move or bad move? It's a good move. We are moving towards the convergence era. So this move would help because now financial statement would be converged. So those companies which are reporting IFRS, they don't have to incur extra cost of making that additional statement. Let's move on. So that would go into background. Yeah, non-cooperation by major G10 countries. IASB is conceptual framework. A framework means kind of a system which will guide you to prepare financial statements. You have to define everything, every process, your objective, constraints, everything. Okay. So IFRS conceptual framework is made of these 3 parts. Number 1, fundamental and enhancing qualitative characteristics of financial statements. Then what are your reporting elements and constraints and assumptions? So your conceptual framework is made of these 3 parts. I converted them to a small table in the morning today. So fundamental characteristics of financial statements. You want financial statement to be relevant. You want them to give you a faithful representation. How do you make them? How do you enhance their characteristics? That characteristics can be enhanced with these 4 points: comparability, verifiability, timeliness, understandability. There is possibility of a question which will list out 3 and will require you to identify which one of these is least likely one of those characteristics. Okay, so you don't have a choice but to remember them. What are the elements of financial statement? These 5. This is fairly straightforward: asset, liability, equity, income, and expenses. What are the constraints in financial statement? Cost versus benefit. For example, let's say you decided that I would try to put the exact fair value of my assets, fair value of my investments, right? But your investments are not listed. You have investment into some private limited companies. So then you will have to recruit a specialist team of valuation experts and make them value that company's investments. Are you following this? And the cost of that valuation would be substantially high. So you have to do a cost versus benefit analysis. And second, that qualitative data is not captured in the accounting world. Meaning of which, let's say, looking at Apple compared to Samsung, that most of their customers are extremely loyal, isn't it? But that loyalty cannot be factored into financial statement. So a constraint with financial statement is qualitative data is not captured and cost versus benefit. And what are the 2 assumptions made for accounting purpose? Number 1 is going concern and second one is accrual. Okay, so this is your IFRS conceptual framework. So what might help if you can? Yeah, IISB conceptual framework using which they've made IFRS. Yes, it might help if you take a photograph or you can make notes out of it, but make sure you remember these points as it is. And now start answering the question. That's why, it's very easy to read. Come on, we just read the whole thing. I'll give you one more chance. Yes, now tell me what is the answer? A, yes. Consistency is not a qualitative characteristic. Good. This time you've done better. Yes, so remaining ones are. But you've done better because I could not think of a good quality wrong option. Had I thought of a good quality wrong option, it would have been very difficult to answer. So these are the 4 points you need to remember. I don't know how you will do it, but you'll have to do it. Good, yes. Going concern and accrual accounting. Alright,